Markets hitting record highs today, and the upturn since April, when tariff fears were at their height, has been spectacular. Our guest says that you should be still in growth stocks with this rally in the markets. We're joined by David Laut, Chief Investment Officer at Abound Financial. David, thanks very much. Just touch on these job numbers, if you would, quickly. I know you're not an economist, but it does seem that the market has decided for sure interest rates are coming, or interest rate cuts.
That's right. I think these numbers aren't largely surprising and certainly firms up that rate cut in the coming weeks and possibly more rate cuts later this year. And so as you can see, the market likes that. The market and the economy are not tied closely, right? Always prices, then earnings, then the economy. And I think this sets us up for, honestly, probably 12 months of positive market action, even if we might get a little volatility here in the short term.
You broadly think growth stocks are the place to be? You wouldn't be seeking out defensives like utilities, for example?
Utilities have done well this year, but no, I think the market is telling you right now where to have the bets for the next 12 months. Small cap, mid cap, anything long duration, Mag 7, even areas like Bitcoin, all of those places are looking really nice today. And I think that those will benefit most from rates coming down. And so we're positive, even though here in the short term, we might get a little bit of volatility. I wouldn't be surprised maybe over the coming 6 to 7 weeks to see the market come back a little bit. That's how we're thinking about putting new money into the market. But when you start looking out 3 months, 4 months, 12 months, I think you see a pretty positive picture for equity indices.
That's interesting. Of course, September and October can be rough. But you say the S&P 500 has a good shot of getting to 7,000 by the end of the year?
Now, I'm going to say something kind of crazy, but let's just start with the setup. The setup is we have negative investor sentiment, we have negative consumer sentiment, we have high valuations, and we probably have a cycle of falling interest rates. If we can get sentiment into action in terms of people starting to feel better about things, I think this market could really take off. And frankly, albeit with some volatility maybe next year, I wouldn't be surprised over the next 2 years having another 20% correction. But I think in the coming 24 months, we're headed towards 9,000. So as 7,000 probably here in the next 3 to 5 months as a stopping point on the way to something much higher.
What would be the driver for that? Massive investment in AI, for example?
Absolutely. As one point, I think that what you see now is the markets are so kind of exacerbated by these bullish sentiments or bearish sentiments when it comes to volume and when it comes to just kind of trends. And so, we used to have a 20% correction and everybody, kind of ducked for cover. That's hardly even a bear market anymore. Think about earlier this year, a great example. So I think that as we continue to have more people get excited about the market, I think that could send things probably beyond where they should be. But as an investor, you just have to follow prices.
Are you worried, though, about the risk of an AI bubble if it turns out companies make these huge investments, but it doesn't deliver profits?
I think we have to wait and see, right? Certainly, we've seen this movie before. The late 90s is really kind of what this feels like in many respects. Number of years already of high returns, albeit with higher volatility, probably with more to come. But that being said, if we get some easing when it comes to monetary policy, maybe those earnings can catch up and justify the above average valuations. So we'll see. But I think that the trend is certainly higher, and I think the inertia behind that is only going to increase once we get past maybe some short term, potentially settling here in the next few weeks.
Is there an area of the market that you would be cautious on, that you would avoid, whether in the US or elsewhere?
I'm concerned about long-term rates. We certainly have short-term rates helping fixed income investors, right? Because we've got rates coming down. We've got a ton of demand from purchasers like Circle and Tether now required to back their stable coins with U.S. Treasuries. I am concerned about the longer side of the curve. I'm really not that excited about anything that's defensive, whether it's utilities, consumer staples, et cetera. So that's probably what I'd be staying away from. I think that, again, look at what's happening today. I think that what is winning today is going to be what's winning over the coming 12 months.
What about this fear that investors would avoid U.S. assets because of unpredictability in Washington?
Well, I don't think that that's been the case in the past, right? We've had plenty of unpredictability. Unpredictability is the only thing that is certain, right? And so I think that as we look out further, even things like Fed independence, tariffs, all those things are transitory in my view. And really what it comes down to, especially being reflected, today's a perfect example of what's to come.
Just, I mean, to be the devil's advocate, this rising unemployment rate in America, it's hitting its highest since 2021. That is going to be a drag on corporate profits, presumably. I mean, certainly for companies that deal with consumers. Those ebbs and flows are so disconnected. I think COVID's such a great example. Think about that. We had a tremendous market decline in a very short amount of time, waterfall decline, not dissimilar from this year. We had a new market high within, 10, 12 weeks? And COVID had hardly even gotten to North America at that point, right? We hadn't even begun to see the effects from a business standpoint. So I really caution investors when they're listening to economists, because I think economists are going to point you away from the right direction when it comes to stock investing and where those prices are headed, because those prices can be 6 to 12 months disconnected from what's happening in the economy today. You're so right that they often move in completely different directions. Yeah. Thank you very much, David. Really appreciate it. David Laut, Chief Investment Officer at Abound Financial.